This is the Thompson Cast. I am Mel Thompson. In the 1990s, Japan had serious economic problems. They had serious problems with their banks. The reason was that their banks had structural defects that at first Japan did not address. It seems that Spain's in the same type of boat currently, and they are not addressing the structural defects with their banks. And the boat that Spain is in is sinking a lot faster than the one that Japan was in 20 some odd years ago. In June of this year alone, more than $200 billion of bad loans were held by Spanish banks. By not addressing and fixing problems, and when I say fixing problems, I mean directly having regulations that deal with the problems of mortgages and capital. And by not fixing problems within the Spanish banking industry, this is going to be a long-term political risk as opposed to a short-term political risk. It's already starting to turn into a long-term political risk. The primary market that is encompassing this problem with the Spanish banks is real estate. Now, when I say real estate, I mean the full gambit of real estate. This includes construction and other interests direct and ancillary to the real estate markets. Now, usually one industry does not have an impact of this magnitude on the banking industry. However, it is not surprising in this particular case when you look at the fact that 9% of Spain's banks' total loan portfolio is in real estate. This represents the largest share of troubled loans since the Central Bank of Spain began keeping records 50 years ago. How the banks recapitalize and deal with this burden is the key to lowering political risk. The answer is not in the promised $123 billion bank rescue fund approved in June by the 17-nation Euro currency union. The answer is in how Spain deals with the structural risk, including underwriting problems that led to this overexposure in the real estate market. With a recession and 25% unemployment, you're not going to have many people buying homes, and those that do buy homes may not be able to afford them long term. Again, the major political risk I see is the ultimate resolution of the structural risk within the Spanish banking industry that led to these problems, specifically mortgage regulation and capitalization of the banks. Foreign direct investors and businesses must look past bailouts and look to specific concrete proposals from Spain's leaders to prevent this going forward. Simply using the $123 billion as a bailout is a short-term solution to a long-term political risk. And if they just do this, then watch out. But to use $123 billion as a tool to resolve the problem long-term is exactly what foreign direct investors and businesses want to focus on. And when I say focus on the proposals that relate directly to mortgages, particularly underwriting of mortgages, and how much capital these banks must keep. Using $123 billion as a springboard is just a part of that. And obviously the second part is the specific proposals and legislation that comes from Spain's government to fix this as a long-term political risk, using that $123 billion as a springboard. This has been the Thompson Cast. I am Mel Thompson.